The most powerful financial assumption in the world is breaking down. And the people who built their entire economic existence on that assumption are the last ones to know. For 80 years, the answer to every global financial crisis has been the same. War in the Middle East. Buy dollars. Banking crisis in Europe. Buy dollars. Emerging market currency collapse. Buy dollars. Pandemic shutting down the global economy. Buy dollars. The dollar's safe haven status was not just a financial characteristic. It was a law of financial gravity. An axiom so deeply embedded in the institutional memory of every central bank, every sovereign wealth fund, every crisis management playbook on Earth, that questioning it felt less like financial analysis and more like questioning whether the sun would rise. The dollar went up in a crisis, always, without exception, for 8 decades. And the entire architecture of global financial crisis management was built on that single reliable foundation. The foundation just cracked, quietly, in the specific data-visible, institutionally alarming way that foundational cracks always appear, not in a single dramatic fracture but in the simultaneous emergence of stress patterns across multiple structural supports that individually appear manageable and collectively signal that the load-bearing capacity of the structure has been permanently compromised. In the most recent global financial stress event, the dollar did not strengthen the way the model predicted. It strengthened less than historical precedent required. And in specific stress episodes, the precise moments when the safe haven premium should have been most pronounced, the dollar's behavior diverged from its historical pattern in ways that central bank risk models flagged as statistically significant anomalies. Anomalies that have a specific name in the academic literature on reserve currency transitions. They are called safe haven erosion events. And they are the earliest detectable signal that the most consequential financial transition of the 21st century is no longer a theoretical future scenario. It is a current operational reality. Here is why this matters more than any interest rate decision, any earnings report, any geopolitical military development this channel has ever analyzed. The dollar's safe haven status is not just one characteristic among many. It is the characteristic that makes every other aspect of American financial power self-sustaining. It is the mechanism that generates safe haven inflows precisely when America's fiscal position is most stressed, when deficits are largest, when debt is growing fastest, when the financial system is most fragile, providing the demand for Treasury securities that keeps American borrowing costs artificially suppressed at the exact moments when they should be highest. Remove the safe haven premium and the $34 trillion American debt structure does not just become more expensive, it becomes structurally unmanageable. Because the interest rate that the American government can afford to pay on its debt depends critically on the safe haven demand that suppresses that rate below what the fiscal fundamentals alone would support. The safe haven status is the hidden subsidy that makes the American financial empire functional, and the subsidy is being quietly, systematically, irreversibly withdrawn. Let's establish the specific evidence of safe haven erosion with the data precision that the magnitude of this development demands. Because the claim that the dollar's safe haven status is being challenged is not an analytical opinion, it is a measurable, documented, institutionally confirmed observation that appears in IMF research papers, BLS quarterly reviews, and Federal Reserve working papers that receive almost zero mainstream financial press coverage because the implications of their findings are too destabilizing for the official narrative to absorb. The first evidence stream is central bank reserve allocation data. The IMF's currency composition of official foreign exchange reserves, COFR database tracks the currency allocation of approximately $12 trillion in global official foreign exchange reserves, held by 149 countries. Dollar-denominated reserves have declined from 72.7% of allocated reserves in 2001 to 58.4% in the most recent data, a 14.3 percentage point decline over 23 years. The pace of decline has accelerated. The dollar lost approximately 3 percentage points of reserve share between 2020 and 2023, the fastest 3-year decline in the dollar's reserve share since the Bretton Woods system collapsed in 1971. The entities making these allocation decisions are not retail investors or speculative traders. They are the most sophisticated institutional actors in the global financial system, central banks, whose reserve management decisions reflect long-term strategic assessments of currency, reliability, geopolitical risk, and safe haven credibility, rather than short-term tactical positioning. The second evidence stream is crisis period dollar behavior analysis. Academic researchers at the BIS published a working paper in 2023 documenting a statistically significant change in the dollar's safe haven behavior during stress events after 2020. The pre-2020 pattern was consistent and reliable, dollar index appreciation of 3 to 8 percentage points during significant global risk-off episodes, driven by safe haven demand, that consistently exceeded the supply of dollars available at existing prices. The post-2020 pattern shows a measurably smaller safe haven appreciation in comparable stress episodes, the same VIX spike, the same credit spread widening, the same emerging market capital outflow pattern, producing systematically smaller dollar appreciation than the historical relationship predicted. The safe haven premium has not disappeared, it has shrunk, and in financial systems, a shrinking premium is not a stable equilibrium. It is a directional signal toward a smaller and eventually negligible premium. The third evidence stream is the gold versus dollar behavior in stress events. For most of the post-Bretton Woods era, gold and the dollar moved in opposite directions during stress events. Dollar strength and gold weakness during dollar safe haven episodes. Dollar weakness and gold strength during dollar credibility stress episodes. This inverse relationship reflected the market's treatment of gold and the dollar as alternative safe havens competing for crisis capital flows. Since 2022, this relationship has broken down in a specific and historically significant way. Gold and the dollar have been appreciating simultaneously during stress events, both rising with gold rising faster. Simultaneous appreciation of gold and the dollar during stress events is the market's expression of a specific assessment that both hard asset safety and dollar liquidity are being demanded simultaneously, meaning investors are no longer treating gold and the dollar as perfect substitutes but are treating the dollar as a short-term liquidity safe haven, while treating gold as a long-term store of value safe haven. The distinction matters enormously, because it signals that institutional investors are maintaining dollar positions for operational necessity while building gold positions for structural protection against the scenario where the dollar's safe haven status degrades further. They are hedging the dollar with gold while still using the dollar. That is not confidence, that is contingency planning. The dollar weaponization factor is the specific event that accelerated the safe haven erosion beyond the gradual pace that reserve diversification alone would have produced. The freezing of $300 billion in Russian sovereign foreign exchange reserves following the 2022 Ukraine invasion was the single most consequential event in the history of dollar safe haven credibility. Not because the decision was wrong or right in geopolitical terms, because it demonstrated to every central bank on Earth that dollar-denominated assets held in Western financial infrastructure are not safe haven assets in the unconditional sense that safe haven assets status requires. They are conditional assets, safe as long as the geopolitical relationship between the holder and the American government remains within acceptable parameters, and conditional safe haven assets are not safe haven assets. They are assets with an embedded geopolitical risk premium that every central bank with any conceivable reason to fear future American financial sanctions must now price explicitly. The IMF estimated in 2023 that the Russian reserve freeze accelerated central bank reserve diversification away from dollar assets by approximately 2 years. 2 years of additional safe haven erosion compressed into a single policy decision. The erosion of a reserve currency's safe haven status is the most consequential and least reversible financial transition in the history of monetary systems. It has occurred twice in the modern era, with the pound sterling between 1914 and 1944, and with the dollar against gold between 1965 and 1971. And both instances followed a pattern that the current dollar safe haven erosion is replicating with uncomfortable precision. Study the pound sterling safe haven erosion between 1914 and 1931 with specific attention to the mechanism rather than the timeline. Sterling's safe haven status before 1914 was as unquestioned as the dollar's safe haven status before 2020. Britain was the world's largest creditor nation. The pound was backed by gold at a fixed and credible parity, and the Bank of England's institutional reputation was the product of 200 years of financial crisis management that had never resulted in a default or a forced devaluation. Sterling was the dollar of its era, the currency that every nation held in crisis because every nation needed it, because global trade was denominated in it, and because the institutional framework backing it had never failed. The First World War changed one thing that everything else followed from. Britain became a debtor nation. The creditor status that underpinned sterling's safe haven credibility reversed in 4 years of wartime borrowing that transformed Britain from the world's largest creditor to a net debtor, to the United States. The safe haven status did not immediately collapse. It eroded, over 17 years, through a series of individually manageable stress events. The 1925 return to gold at an overvalued parity, the 1929 crash, the 1931 banking crisis, each of which produced a smaller sterling safe haven response than the previous one, until the 1931 crisis produced no safe haven response at all, and Britain was forced off gold permanently. The erosion was gradual, the end was sudden. The 17 years between the beginning of the erosion and its completion contained enormous wealth transfer from sterling holders who trusted the official narrative to the institutions that read the data and acted on it. America's mirror image of that pattern is unfolding in compressed time frame, because the information transmission speed, the institutional sophistication, and the available alternatives are all dramatically greater in 2025 than in 1931. The dollar became a net debtor currency, in the sense that American net international investment position became significantly negative in the 1980s. The weaponization event that accelerated the erosion occurred in 2022. The reserve share decline from 73% to 58% over 23 years is tracking slightly faster than sterling's comparable decline, and the gold's simultaneous appreciation pattern that has emerged since 2022 is the 21st century equivalent of the sterling-gold divergence that preceded Britain's 1931 gold standard abandonment by approximately 8 years. The hidden financial force that makes safe haven erosion self-accelerating once it reaches a threshold velocity is the network effect operating in reverse. The dollar's safe haven status was built and maintained by the network effect. The more countries held dollars as safe haven assets, the more reliable the dollar's safe haven demand was in any crisis, which made holding dollars as safe havens rational for additional countries, which strengthened the safe haven demand further. The same network effect operates in reverse once erosion reaches sufficient scale. As reserve share declines from 73% to 58%, the reliability of safe haven dollar demand in the next crisis is lower than it was when reserve share was 73%. Lower reliability makes holding dollars as safe havens marginally less rational. Marginally less rational holding reduces reserve share further. Further reduced reserve share reduces reliability further. The reverse network effect is not a theoretical concern. It is the mechanism that converted sterling's gradual erosion into the sudden 1931 endpoint. And it is the mechanism that will eventually convert the dollar's gradual erosion into its own sudden endpoint at a pace that the reverse network effect's self-acceleration will make faster than the historical precedent suggests. Watch 5 specific developments in the next 24 months that will tell you whether the dollar safe haven erosion is accelerating toward the sudden phase or has found a stabilization level that extend the gradual phase further. First, watch the dollar index behavior during the next significant equity market correction. A VIX spike above 35. The threshold historically associated with genuine institutional fear rather than routine volatility, that produces dollar index appreciation below 2% would confirm that the safe haven premium has eroded to the point of functional insignificance for crisis capital allocation purposes. Dollar index appreciation above 4% would suggest the safe haven premium remains operationally significant despite the reserve share decline. Second, watch the spread between gold lease rates and dollar LIBOR equivalent rates during the next stress event. When gold lease rates spike above dollar funding rates during a stress episode, when gold is more urgently demanded for immediate delivery than dollars are demanded for immediate liquidity, the market has explicitly priced gold above dollars as the preferred immediate safe haven. This crossover has not occurred in the modern financial era. Its occurrence would represent the most consequential single data point in the safe haven erosion narrative, the market's explicit verdict that the transition from dollar to gold as primary crisis asset has reached operational completion. Third, watch the Federal Reserve swap line utilization during the next global dollar funding stress. The Fed swap lines with other central banks, the emergency dollar provision mechanism that has been the primary tool for managing global dollar shortages during crises, have been the clearest operational expression of dollar safe haven demand. When swap line utilization during a comparable stress event is measurably lower than during the 2008 or 2020 crises, when foreign central banks are sourcing crisis liquidity from PBOC yuan swap lines or BRICS payment architecture rather than Fed dollar swap lines, the operational infrastructure of dollar safe haven status has been structurally bypassed. Fourth, watch the IMF's special drawing rights allocation request from BRICS economies. The SDR is the IMF's composite reserve asset, currently weighted 41.7% dollar, 30.9% euro, 10.9% yuan, 8.1% yen, 8.1% sterling. Any formal proposal from BRICS economies to reweight the SDR away from dollar dominance, or any proposal for a parallel BRICS reserve asset that competes with the SDR, represents the multilateral institutional challenge to dollar safe haven status that bilateral de-dollarization initiatives cannot achieve alone. Multilateral institutional challenge is the terminal phase of safe haven erosion. It is the formal acknowledgement by the international institutional framework that the currency's safe haven credentials no longer justify its institutional primacy. Fifth, and most critically, watch American domestic inflation expectations relative to dollar safe haven inflows during the next geopolitical stress event. The dollar's safe haven premium has historically been largest precisely when American inflation was lowest, when the purchasing power stability of dollar holdings was most credible. In an environment where American inflation remains structurally elevated above 2%, where the $2 trillion annual deficit and the $34 trillion debt load create persistent inflationary pressure that the Federal Reserve cannot fully contain without triggering the financial stability consequences that constrain its tightening, the safe haven premium faces the specific, historically unprecedented challenge of being demanded for crisis liquidity while delivering negative real returns to its holders. A safe haven asset with a negative real return is not a safe haven. It is a short-term operational necessity being mistaken for a store of value. And the institutional recognition of that distinction, already visible in the simultaneous gold appreciation pattern, will eventually produce the reserve allocation decisions that make the friction structurally permanent. Here is the final truth that the quiet challenge to the dollar's safe haven status demands be stated with the historical gravity it deserves. The safe haven status was never really about the dollar. It was about the institutional framework that the dollar represented, the American fiscal credibility, the rule of law, the property rights, the geopolitical neutrality, and the economic dynamism that made holding dollar assets rational for every nation regardless of its political relationship with the United States. When that framework was strong, the safe haven premium was large. When that framework is questioned, the safe haven premium shrinks. And when that framework is explicitly weaponized against specific holders, the safe haven premium is not just questioned, it is structurally repriced by every institution that holds dollar assets and understands that their safety is now conditional rather than absolute. The dollar will not lose its safe haven status in a single dramatic moment. It will lose it in the gradual accumulation of reserve share declines, safe haven premium compressions, gold simultaneous appreciations, and weaponization-driven diversification decisions that are already visible in the data and already operating in the institutional allocation decisions of the central banks that manage the world's $12 trillion in foreign exchange reserves. The gradually is already well advanced. The suddenly is on a timeline that the data is making shorter with every passing quarter. And the people who will be most surprised by the suddenly are the people who are currently most confident that the gradually cannot possibly reach it. The assumption that felt like gravity is not gravity. It is history. And history, unlike gravity, has a direction. And right now the direction is being quietly, systematically, irreversibly determined by the data that the official narrative is working hardest to prevent you from connecting into the coherent picture it actually forms.